Good evening, friends. Hope you are well and doing fine. I'm Ashok Kanawala, and on behalf of HDFC Mutual Fund, I extend a warm welcome to all of you to this webinar. As you may be aware, yesterday, HDFC Balanced Advantage Fund completed 30 years. And this call is to discuss about its update and the way forward. This fund is also a 30-year-old fund and has delivered a CAGR or a since inception track record of nearly 18.5%. So it's not only that this fund also did not have a challenging time. This fund also had a challenging time at some point in time. Good times, bad times are part of this. But what this fund has achieved over 30 years makes it a little different fund, a unique fund. And today, as we speak, it is the largest fund in the industry as far as equity-oriented funds are concerned, and even for us on the side of actively managed. This was one perspective that how you read its performance of 18.5%. And there will be so many funds today on a 1, 2, 3 year basis, maybe doing more than delivering more than returns. But idea is to deliver and show you what this fund has done for 30 years. It's another matter that today also on a 1, 2, 3 year basis, this fund is performing, is in the top position as far as this category funds are concerned. Second analogy that I would like to say that India's population is 140 crore people, roughly. That's what we understand. But the median age of India is roughly around 28 years. And this fund has been in existence for nearly now 30 years. So 30 years, that's what is completed. So 50% or 70 crore plus population actually was born out of after this fund actually started. And we always say that India is a young country. From that analogy, I say this fund is not a 30-year-old fund, but this fund is 30-year young fund. And rightfully what I'm saying that and why I'm saying this, because as we stepping into Amrit Kal and we have a very promising outlook for next 25 years going forward, this fund with your support, I think can go many places. And we are also aware about the its size, and we are also aware about the importance of this fund is concerned. And therefore, today this fund is not managed by one fund manager or two fund managers, it's managed by 4 fund managers. So we have on this call with us Gopal Agarwal, who is a equity fund manager for this strategy, whose main job is stock selection. Then we have Anil Bamboli, whose job is to manage the fixed income part of it. As you know, this is a hybrid fund, which dynamically manages the equity and debt portion. So Anil manages the fixed income part of it. Then we have Arun and Nirman for arbitrage strategies. And then finally, we have Srinivas Ramamurthy. As you know, that this is a dynamically managed fund, so their equity and debt keeps on changing in line with the valuation. So Ramamurthy actually advises the fund manager what should be the right asset mix in terms of equity and debt. So there is a team of 4 to 5 fund managers where they are managing various strategies associated with this fund. And that's the importance that we have given to this fund. And of course, there is head of equities, there is head of fixed income. And on top of that is Mr. Navneet Munot, who is our MD and CEO. Cumulatively, all these people who are on this call today with us, 4 people from the investment side, and of course Navneet, they have a collective experience of more than 100 years. So I think that's the kind of importance and strategic importance that we have placed on this fund. And we would like to see your continued support going forward also. So without much ado, I will now invite Mr. Navneet, our MD and CEO, to say a few words on this fund and the way forward. And of course, thereafter, we will introduce one after another fund management team who will speak on the various strategies that they manage regarding this fund. So over to you, Navneet.
Thank you, Ashok, and thank you everyone for joining us on this momentous occasion. It's a momentous occasion for us, for all our investors, our partners, everyone associated with HDFC AMC, or I would say everyone associated with mutual fund industry in India, an occasion to celebrate the 30th anniversary of HDFC Balanced Advantage Fund. The fund has not only one of the longest track record, but with an AUM of over rupees 75,000 crores, it is one of the largest funds in the country. And as Ashok mentioned, it has a stellar track record over the last 30 years. If you go back in last 30 years, India's market cap would have risen from 4 or 5 lakh crores in those days to almost 380 lakh crores today. Sensex was 4,000 back then, and it has grown about 18 times. Compared to this, HDFC Balanced Advantage Fund has grown a whopping 160 times. A 1 lakh rupee investment at inception 30 years ago is over rupees 1.5 crore. An SIP of 10,000 rupees per month over the last 30 years is over 13 crore rupees today. Just shows the power of compounding, just shows the disciplined investing that this fund has been able to display. The success of this fund is testimony to the time-tested investment philosophy and robust processes at HDFC AMC. And this has helped us in navigating multiple cycles. There would have been many market cycles, economic cycles, credit cycles, rate cycles, business cycles, many political events, domestic, global, changes in technology, regulation, and a whole lot more. And in that period, a 1 lakh rupee invested at the time of inception has become almost 1.5 crore, or a 10,000 rupee per month SIP has become 13 crore rupees today. Uh, HDFC Balanced Advantage Fund is part of a comprehensive range of products on asset allocation built on the foundation of our experience, insight, and resources. An investor can choose from a variety of hybrid funds based on their risk appetite, investment goals, and time horizon. While we are celebrating 30 years of this fund, but we have many other hybrid funds that have a track record of 10, 15, 20 years and more, and have generated alpha over these years. Even if investors pay heed to the tenets of diversification, getting portfolio diversification right as per one's financial journey is easier said than done. That's where the wide array of hybrid mutual fund schemes like HDFC Balanced Advantage Fund can make things easier for investors. And these schemes offer diversification not only across asset classes, but across sectors, across market cap segments within equities, and of course, not to mention the professional expertise in security selection, but also in the on the fixed income side, exposure to duration, to credit, and to various segments of the market. And it would be fair to say that in the world of personal finance, mutual funds not only create the concrete, but also help build the road to financial freedom in the long run. For the investor looking for higher equity allocation, there is hybrid equity fund. HDFC Equity Savings Fund reduces volatility through investment in arbitrage as well. Our multi-asset fund adds the diversification of a third asset class of gold as well. Our asset allocator fund is an easy way to diversify across multiple equity schemes. HDFC Hybrid Debt Fund gives a conservative option to allocate into equity. And of course, our solution funds are available for investment planning for children gift fund and retirement fund series. So while we are celebrating the 30 years of Balanced Advantage Fund, I would like to take this opportunity to say with great sense of pride that if asset allocation is key, HDFC AMC makes it easy. If asset allocation is key, HDFC AMC makes it easy. And we have an incredibly experienced team for our entire hybrid platform. So if we take the case of HDFC Balanced Advantage Fund, as Ashok mentioned earlier, asset allocation is done by Srinivas, equity stock selection by Gopal, fixed income is managed by Anil, and arbitrage portion is managed by Arun and Nirman. And of course, we have various supporting, the team members in the investment team to ensure that we deliver the best to our investors. And the funds like Balanced Advantage Fund have been able to deliver this because of our intense focus on every component of everything that I talked about in terms of various asset classes and within that, the various components. And that helps us in generating alpha through various sources. And our processes and experience research capabilities within each component is what has led to the phenomenal alpha generation over time. And we continue to work on how we can further optimize every single source of alpha, and my team members will talk more about it. Srinivas will talk about the monthly asset allocation committee, where we look at every single quantitative and qualitative factors, be it macro, valuation, the trajectory of corporate profitability, liquidity, and market segment, as far as equities are concerned. Similarly, on the bond side, looking at the macro from a duration perspective, security selection, so on and so forth, and all in a great level of detail to arrive at the asset allocation for our hybrid fund. We also deep dive into every aspect of the allocation within the each asset classes. The entire process is supported by a robust risk management. Delivering this value over 30 years is a testimony of our investment management as well as the risk management capability. And risk management for us is not an after the fact activity. It is deeply ingrained into the investment process. We have a highly experienced and qualified risk management team that continuously monitors risk from all angles and with best-in-class tools at their disposal. So again, I repeat, if asset allocation is key, SDFC Mutual Fund makes it easy. At SDFC AMC, we have a mantra for wealth creation. And when I talk about the wealth creation by SDFC Balanced Advantage Fund for 30 years, I get reminded of what we keep repeating. Wealth creation in the long run can be achieved through a formula, which is STP, sound investment plus time plus patience. And SDFC Balance Advantage over the last 30 years has shown that formula truly works. As the late Charlie Munger put it, and in our annual yearbook, I'm sure all of you would have gone through that. In case not, I would strongly recommend you to go through that. It has plethora of chart and quality information. It also has many quotes from the veteran investor Charlie Munger, who said that the big money is not in the buying or selling, but in the waiting. And the investor who could wait for this long period are the ones who have reaped the full benefit. So thank you once again, and many congratulations to everyone. Congratulations and many thanks from the bottom of our heart to each and every distributor partner who have been a big part of the success of HDFC Balanced Advantage Fund's glorious 30 years history. And finally, my sincere gratitude to all the investors of HDFC Balanced Advantage Fund for your trust and confidence in us over these 30 years. As we look back and celebrate the last 30 years of this fund, I'm even more excited about the next 30 years. We are just beginning the Amrit Kal of India. And even beyond, as a platform, what I talked about earlier, we are here to serve you with a deep sense of purpose, with a deep sense of mission. And that mission for us is to be the wealth creator for every Indian, to be the wealth creator for every Indian. On that note, I would like to invite my colleague Srinivas to talk more about our asset allocation for Balanced Advantage Fund in particular, and of course, which is applicable to all the other hybrid strategies that we run, a large number of hybrid strategies to meet various return expectations along with the risk appetite and liquidity needs and the exposure to various asset classes that an investor would look for or a distributor partner would look for. In fact, I would just like to repeat, even at the cost of repeating, if asset allocation is key, HDFC AMC makes it easy. Thank you so much.
Yeah, Srinivas, good to go.
Yeah. Thanks, Navneet, and thanks, Ashok. So, Ram, if you could just put in those few slides that I wanted to take them through.
Sure, Srini. Srini, you can begin. I'll just load it in a second or so.
Yeah, sure. So, good evening, everyone, and I'm really kind of very happy to kind of touch base with all of you on this momentous occasion, like Navneet mentioned. What I would look to do is I would look to share some broad thoughts around the approach that we follow towards asset allocation in this fund. I would primarily like to focus on some of the principles that guide us on this and the processes that we follow to reflect on those on those principles. So if you look at this product itself, I mean the positioning of Balanced Advantage Fund within this entire basket of hybrid products that we have, it is really a very unique product in the sense that it is one of the most flexible products that we have. And because
Srini, just
in
a request from Srini, it's just a request from
yeah,
investors if we can mix Hindi and English both.
okay, yeah, sure, right. So basically, it's a very unique product, and the uniqueness of the product primarily comes from the fact that the range of asset allocations that you can kind of execute in this product is it's obviously very wide. जैसे कि हम जानते हैं ये एक प्रोडक्ट है जहाँ पे आप आपकी इक्विटी एक्सपोजर और डेट एक्सपोजर में आप बहुत आई मीन बहुत बड़ी रेंज का आपको आप फायदा उठा सकते हैं जो बहुत कम प्रोडक्ट्स में अवेलेबल रहता है। तो इफ वी लुक एट जस्ट जो अनहेज्ड एक्सपोजर हम जो बोलते हैं, इफ वी लुक एट द अनहेज्ड एक्सपोजर, दैट रेंज इटसेल्फ कैन बी बिटवीन 0 to 90% इन द केस ऑफ इक्विटीज फॉर इंस्टेंस। Obviously, given the fact that हम इस प्रोडक्ट में वी ट्राई एंड प्रोवाइड द इक्विटी टैक्सेशन बेनिफिट टू द इन्वेस्टर्स, तो उस वजह से हम इसकी ग्रॉस इक्विटी एक्सपोजर हमेशा 65% के अबव रखते हैं। बट एट द सेम टाइम जो नेट इक्विटी एक्सपोजर होता है जिस 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 पे द रिस्क ऑफ द प्रोडक्ट एक्चुअली और द वोलेटिलिटी ऑफ द रिटर्न्स ऑफ द प्रोडक्ट जिस पे डिपेंड करता है, वो रेंज ऑलमोस्ट 0% से 90% तक इस प्रोडक्ट में हम रख सकते हैं। एंड इसका ये फायदा है कि ये हमें एक फ्लेक्सिबिलिटी प्रोवाइड करता है दैट वी कैन डायनामिकली मैनेज द एसेट एलोकेशन ऑफ दिस प्रोडक्ट। एंड इस डायनामिक एसेट एलोकेशन की वजह से हम वोलेटिलिटी जो है जो फाइनली जो इन्वेस्टर एक्सपीरियंस जो हम बोलते हैं, दैट वी स्ट्राइव टू इम्प्रूव दैट इन्वेस्टर एक्सपीरियंस at the end of the day. What we find is that in many of these products, the key is obviously that when there is a reasonable exposure to a volatile asset class like equity, what we find is in a large number of instances we find that there are mistimed entries and exits from investors, and this largely happens because of the volatility. So many a times the end investor returns are not, sometimes many cases it is subpar compared to the fund returns, and which is something which obviously is very undesirable. तो इस वजह से हम हमारी कोशिश यही लगी रहती है इस प्रोडक्ट में, जब हम एसेट एलोकेशन डिवाइस करते हैं और जो फ्रेमवर्क्स हम डिवाइस करते हैं, हमारी कोशिश यही रहती है कि हम ये जो वोलेटिलिटी है हम इसको रिड्यूस कर पाएँ, एंड वो इन्वेस्टर एक्सपीरियंस को ऐसा मैनेज कर पाएँ कि इसमें जो इन्वेस्टर्स का एग्जिट करने की जो ये आई मीन द डिजायर जब भी आए वो कम आए, एंड हेंस ही एक्सपीरियंस द एंटायर journey of the product returns. So that is one of the key areas of focus. And like Ashok and Navneet mentioned, this obviously this product has a very long history of wealth creation, and that clearly remains a very key focus area for us even going ahead. And which does not obviously mean that we will always be aggressively positioned in all market conditions. And that is where I think what I would want to touch upon is how does the asset allocation framework help us in bringing in the discipline that is required to ensure that from time to time we take the requisite actions to keep the product delivering a more stable kind of return profile. So coming to the asset allocation framework, what we see is that the way we try to add value through the asset allocation calls is primarily by being counter-cyclical. And whenever we say that we want to be counter-cyclical, towards that end, obviously, valuation becomes one of the key building blocks for the framework, and in evaluating what is the right level of allocation that you should have between the different asset classes. Here, obviously, the asset classes in this product are primarily equity and debt. एंड अगेन जब हम वैल्यूएशंस की बात करते हैं, बहुत सारे पैरामीटर्स हैं जिसके बेसिस पे हम इवेलुएट कर सकते हैं कि मार्केट की आई मीन बोथ ऑन द इक्विटी एंड द डेट साइड how the markets are valued, and whether they are attractive in absolute terms or in relative to each other terms. But what we find based on our back testing is that the trailing price to earnings ratio and an earnings yield to bond yield ratio, we find that
Srini, I think there is some issue with the connection. We missed you maybe in the last 30 seconds. Maybe you have to cover that again. Yeah, thanks.
Okay, sure. I'm audible now, right?
Yes, now, yes.
Yeah, okay, perfect. So what I mentioned is that from a valuation standpoint, we find from our backtesting that trailing price to earnings ratio and earnings yield to bond yield ratio are particularly useful in the Indian context, and hence a fair amount of, I would say, weightage is given in our framework to these two parameters from a valuation standpoint. Further to valuations, we also look at a wide array of parameters, most notably the macro aggregates, sentiments, liquidity, and these all help us gain further insights into the market cycle. And we are particularly conscious about the fact that about extreme points in any of these segments of parameters gives us useful hints towards inflection points in the market cycle. And basis these, we arrive at the asset allocation ranges, and we try and we basically restrict our asset class exposures within those ranges. At a very broad construct level, while like I mentioned, this product allows us to go in a very wide range of 0 to 90% on the equity side. But under most normal circumstances, what we try and do is to restrict it to between a 40 to 80%. But there are obviously, of course, there are exceptional circumstances जहाँ पे हम ये 40% and 80% के range के बाहर भी जाते हैं. But under normal circumstances, I think it is fair to assume that we would be operating in this kind of a range from an equity standpoint. And obviously, what is not in equities will largely be in a mix of arbitrage, which is the hedged exposure, and the debt exposures that we take. Just moving on from the framework, and just to kind of give you some sense around how this framework has helped us navigate through the past a few years. This chart here, for instance, tells you how the allocation how our net exposure to equities has kind of moved over the past since the post-COVID period. And what you would find is that there has been a wide range of changes that have happened in the asset allocation side. I mean, we have moved from 80% to 55, 56, 57%, moved back to about 70 odd percent, and again have come down to 56, 57%. And this kind of addresses one key investor concern that we keep getting on this product, which is that does a large AUM kind of hinder asset allocation changes? ये बहुत कॉमन कंसर्न रहती हैं लोगों की कि ये फंड अभी जैसे कि हमने बताया ऑलमोस्ट 75,000 करोड़ का AUM का फंड है, तो इस साइज पे क्या हम अपने एसेट एलोकेशन चेंजेस को हम एग्जीक्यूट कर पाते हैं? And this kind of gives you a kind of ready answer to that. We have been able to do it in the past, and we find really no constraints in doing this as and when we want to do it. And that largely comes from the fact that we maintained a very fairly liquid, I would say, portfolios both on the equities and the debt side. That gives us this ability to be flexible and execute the model from a rebalancing standpoint on a very frequent basis, as and when the framework requires us to do it. So I think these are just some broad thoughts that I thought I would share around the framework and the model, and obviously we can get into details if there are any specific questions at a later point in time. But with these initial comments, I think I would hand it back to Ashok and the rest of the fund management team, and happy to come back later. Thank you.
Thanks, Srini. I think so. That's what the dynamic nature of the portfolio, that equity and debt keeps on changing in line with the underlying valuations and market cycles. So that's what he explained. Now we will now invite Gopal, who is our equity fund manager responsible for stock selection, to share his thoughts on how he's managing part of the portfolio and what does it look about markets at the current juncture. Over to you, Gopal.
Thank you, Ram and Srini and Navneet sir. And welcome all the participants to the 30th year celebration of HDFC Balanced Advantage Fund. It is my privilege to host you for this occasion and just share my thoughts and how I am looking at equities and how we are managing the portfolio. So, very clearly, as the asset allocation is done by Srini, so we use that framework, and based on that, we are currently running around 57% equity allocation. And since I took over in July 2022, we have brought down progressively equity allocation from 68% to closer to 56-57% as the market has rallied during this period. Despite I am reducing the equity exposure, and on an average, we run 59% equity in the last 12 months, and that fund has delivered this kind of return. So what I am really looking at, first of all, as this, I always say the market is a function of earnings, earning growth, liquidity, and interest rate. The best part is that we are seeing really this earning cycle in India has improved tremendously with the banking industry is getting much in a stronger phase with reduction in the credit cost, loan growth in double digit. So that has really helping the overall buoyancy in Indian economy. Second part, what we are seeing, the global energy prices and inflationary pressure are moderating, which is helping the corporates to, maximize the productivity and profitability over the cycle. Third point is that what we are seeing clearly as global growth is weak. So every company is focusing more on capital productivity and efficiency of the capital. So, and everybody has gone through the bad cycle of, ILFS driven liquidity crisis in India to COVID period and some slowdown because of US-China trade war. So every balance sheet in corporate India has improved tremendously. And even in small cap industry companies, we have seen the debt equity ratio has come down to as low as 0.2. On an average, Indian corporate debt equity ratio has come down from 1:1 to 0.59:1. So that is why the corporate India's balance sheet has improved a lot. And what we are seeing, India has shown resilient GDP growth rate during this period when global economy is going through the turbulent phase. So net, we are in a very strong earning cycle. We have seen in the last 2-3 years from 450 EPS of Nifty, we have touched closer to 800 and 832 last year. So, and progressively also the outlook on earning growth is in double digit. So earnings outlook is improving. Inflationary pressure worldwide, including India, is under control, and energy prices are moderate. So the earning growth is very good. Third point is that in India, because of implementation of PLI and government support to electronic exports, we are seeing our services surplus has moved from $7 billion to closer to $14 billion on a monthly basis. So despite the goods export is weak, we are seeing our trade deficit is under control and current account is under control. So the currency going forward is likely to behave in a band which augurs very well even for the FII flows into the country like India. So that is why I'm positive on the liquidity. As post June, you will see because of bond inclusion, there will be likely to have some flows into our bond market, which will improve our domestic liquidity. So net, the situation augurs overall well for the earnings trajectory. The only caution I would like to give on valuation. Today, the valuation is not at the best of the comfort zone, but it is not out of control. So that is the only word of caution from my side, that valuation is not in very much comfort zone, but it is in manageable zone at this point of time. Now coming to our fund, the HDFC Balanced Advantage Fund, the way we are managing. So currently, I am very positive on domestic cyclical sectors, which are benefiting from government resolve to improve the supply chain, logistic, and we are seeing the power sector, the infrastructure sector, railway, defense looking very strong. So our portfolio is more biased towards the domestic cyclical at this point of time, as we are in a benign domestic scenario, and government tax collection has improved over years, and you are seeing that our fiscal deficit is under control. And last year's last in FY in s- last year we have seen the government capex has gone up by 35%. So the capex related sectors are doing good. Policy support is there in many of the basic infrastructure sector of the economy. So, and they are also having the tailwind of softer commodity prices. So that is where we are more positive, and we are overweight on industrial, energy and utilities, and pharma sector, and we are equal weight on financial and underweight on IT and consumer staple. So that is the portfolio strategy at this point of time. And what I am trying to do is to manage the risk in the portfolio in terms of actively sizing the portfolio bets. So that the our in mutual fund product, the investors comes at different point of time. So what I am trying to do is to have a very a reasonable expect return and return journey for the investor. So once it should not happen that we make the maximum return today, and that tomorrow it will have a very negative impact on the performance. So I am sizing my bet on a dynamically basis, and moving money from one stock to another stock in such a way that this is an effort to have a smoother output for the investor. So that is where we are. And in our fund, we are now progressively moving more towards the large cap. So currently, we have over 80% allocation to large cap in our fund, and closer to sub 20% in mid and small cap. So that is why, as Srini has mentioned, we are now dynamically managing the fund. So this large cap orientation helps us to dynamically manage the equity allocation well in the product. So I stop here.
Thanks, Gopal, for your thoughts on the equity allocation. Now, we will invite Anil, who is managing the fixed income part of the fund. Uh, as you know, that fixed income, see, the large part of the return comes from the equity side, but fixed income also plays a very active role in bringing stability to the fund's volatility. But more pertinent to know, for you to know that over last 30 years, this fund never had any credit event. And you know that in last couple of years, there have been a couple of credit events in the MF industry as well. But this fund has stayed clear of all kinds of credit events, and thanks to the fixed income strategy that we follow. So I will now invite Anil to share his thoughts on how he goes about managing the fixed income portion of the fund.
Thanks, Ashok. Good evening, everyone. So briefly, while debt, as Ashok mentioned, the endeavor is to provide stability in this whole product that is dynamically allocating equity to capture the changes that keep happening on the equity side. The debt part is also actively managed. The first philosophy, as Ashok already mentioned on the credit side, that we didn't experience any accidents so far. Our basic philosophy is SLR, which is safety, liquidity, and returns. So our always endeavor is to be in the safe assets, which are liquid. Returns are the last priority when it comes to the philosophy of investing. This is a philosophy not only for this product. This is the philosophy we follow across our debt products that we manage. The duration also of the product is actively managed. Like 2 years ago, we were nearly at 1.5 years duration. Currently, we are at around 3.5 years duration. So based on the view that we have, the duration is increased. We continue to increase our duration going forward also. Various factors which are favoring this view is that CPI in FY25 is likely to average around 4.5% compared to 5.2 in FY24. Current account is very comfortable. I think global also scenario is much better. I think with most large central banks also indicating they have reached the peak of the rate hiking cycle and are more likely to cut in the next 12 to 18 months. Budget has also been very positive. I think it positively surprised the whole market by announcing a 5.1% fiscal deficit. Market was expecting around 5.3 kind of a number. Not only that, the gross borrowing number also has been on the lower side, and hence there has been some rally in the last 2 days. But I think we still feel that there is still some room for yields to go down, and hence I think we will keep increasing duration for some more time. I think this is the broad view that I have on the fixed income side. We will take more questions as and when they come. Thanks.
Hey, thanks, Anil, for your comprehensive view on the fixed income part of it. As I said, that even at 75,000 crores of AUM, the kind of investment processes and risk management that we follow, it gives us a very comfort level that we can still continue to manage this fund with this size and continue to grow. And there has always been a myth in the minds of investors and sometimes in partners that size is always a constraint. But when you look at our performances across time period, I think that myth can get easily negated. And that makes this fund beginner's choice, but everyone's delight. Beginner's choice, why? Because it's a combination of debt and equity and therefore lower volatility as compared to equity. But when you look at its long-term track record, it comprehensively outperforms Nifty 50, which is a generally followed benchmark, as well as quite a few of the pure equity funds also. And therefore, it becomes everyone's delight as well. So, with this, we had Gopal, we had Anil, we had Srini, who talked about the model, talked about equity selection, who talked about the fixed income outlook. So, thank you, everybody, on this call.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.